Good afternoon. This is James Perry at Perry Capital in Miami, and the first week of June is history. The S&P 500 closed above 6,000 for the first time since February. It was up 1.2% on the week. The Dow was up 1%, and the Nasdaq was up 2.2%. As usual, we are going to talk about our strategy, our forecast, and our asset allocation for June, the next quarter, and into year end. First, though, let's take a little peek backwards about the developments we saw in the market, domestic policy-wise, geopolitically, economically, and what the market data told us about where we are and where we're going. The first segment of this week's report is going to concern itself with domestic politics. The reason for that is I want to get it out of the way. I find them annoying. I find the narrative surrounding them noisy. I find them distracting, and I think the uncertainty surrounding them inhibits good investment making decisions. The reason it's a problem is because that budget deficit of $2 trillion, which is quadrupled in the last 4 years, has to be financed in the bond market every day. 10-year Treasuries are at 4.5%. That's above the monthly, quarterly, and yearly average of the 10-year yield, and I think it would be a lot lower if inflation expectations had the chance to come down. That only happens when spending cuts materialize. That has not happened yet, and I doubt it will. In the meantime, inflation, aggregate inflation, is probably up 25% over the last 4 years. This is hurting small businesses and households the most. The stock market likes it, especially big cap tech. They can avoid margin squeezes, and then they can raise prices because there's demand for their products. No surprise to see that the technology sector of the S&P 500 was up 3.3% last week. It's led the charge. And in fact, from the April lows, it's up almost 40%. So big cap tech is still the place to be. That's your allocation. The fact is, the market, and the reason I reduced my allocation to equities from 87.5% to 70 in the last 3 weeks is I don't think these spending cuts are going to be coming in the next month. And I think that's a risk for the market. Higher rates will hurt the economy and the stock market. Geopolitics, in the best of times, are a three-dimensional chessboard. And in disruptive and uncertain times, it's even more complicated than that. Investors are having a hard time looking at the information and the headlines, knowing that they don't know the whole story of anything, and trying to make economic decisions and market decisions. I think investors would be best suited to recognize there's probably two main issues that need to be addressed. One is that the rivalry between the U.S. and China is becoming more acute, economically, politically, militarily, and technologically. And Donald Trump, on top of that, is trying to balance the America First agenda with the idea that that does not mean America alone. It means our allies and our partners and our neighbors in the West, the Western democracies. China is got a couple of problems. Number one, they've got to keep exporting because they don't have enough domestic demand. And to keep exporting and manufacturing, they need energy, and they've got to get that from Iran, Russia, and Venezuela. Trump believes that he's got an upper hand on that because he can enforce sanctions a little bit more aggressively. That's harder to do than most think. And he thinks it's with some of our allies who are in the middle of transporting Chinese goods, which are subsidized by the Communist Party of China, namely Vietnam, India, and to a lesser extent, but still very real, Mexico and Canada. China is a low-cost producer and exporter of steel and aluminum. Europe, especially Germany, they sell a lot of cars. And Canada and Mexico are responsible for a lot of the domestic automobile manufacturing and assembly for this country. These are very, very complicated issues. It's interesting to see that the Ukrainian stunning drone attack on Russia's bombers was incredible. I haven't talked to anybody that doesn't believe that either NATO or the CIA or the U.S. military was not involved. Putin knows that. The Chinese know that. I also think it's very interesting to see Chancellor Merz having come to Washington last week and talking about automobile exports. That's a complicated issue because the Germans make good cars. We don't. We are the most expensive producer of automobiles with the lowest quality in the Americas. And that's not a very good starting point. The point is, tariffs are probably going to come on to the Japanese, Korean, Indian, and European automobile manufacturers. And they're not happy about it, rightfully so. But to get those to be reduced, and I think they can be, the issue really at hand, not so much with Europe, but with certainly, Vietnam, India, Mexico, Canada, it's a transshipment of subsidized products coming from China. Trump is going to use sanctions and tariffs with our neighbors and allies so that the tariffs that we want to put on the Chinese will also be put on the Chinese by Mexico, Canada, and India and Vietnam. That's very tricky as well. We're going to see how that goes. And the markets are still going up because of all this stuff. So the markets feel comfortable with this and the idea that it's going to get resolved. Hope that's true. The fact that Trump and Chairman Xi actually spoke on the phone for an hour and a half this past week, and that they've agreed to have a trade delegation meet in London next week is a very positive development. I really believe that China has a lot to lose by not getting to a closer and fairer trade situation. I think that Canada and Mexico do too, as does India and Vietnam. These are the 5 largest or so major trading partners with this country. Trump wants to get to fair trade. That means get toward the global average, which is about 6.5%. U.S. tariffs are about 2%. I think we will get there. It's not going to be easy and it'll be disruptive for everyone. But at the end of the day, it really is about containment of the Chinese export manufacturing machine, which is subsidized by the Chinese Communist Party. It is estimated that the Federal Reserve System employs over 2,200 economists. These people, they're not really economists, they're econometric thinkers, and they study models, right? And the trouble with models is, and the reason that they're such bad forecasters is they don't handle disruption and change very well. This is a time of great disruption and great change on many levels. The fact is, these guys are in the bottom quartile of forecasters perpetually, right? And it's not just the Fed. It's the ECB, it's the IMF, it's the OECD. All of these groups do the same sort of thing. And this is why the market is doing well, but the narrative around the market is very negative. The Atlanta Fed does a nowcast, which just looks at data, and their forecast for Q2 GDP is 3.8%. And the latest inflation reading is the lowest in 4 years. So yes, there's aggregate inflation that's still in the system. And this is why taxpayers, small businesses, want to see spending cuts. If we don't get spending cuts, these inflationary and lower growth expectations will materialize. But the fact is, as an optimist, I really believe they're coming. I think the trade deficit will go down. I think that the budget deficit will go down. I think national debt will go down. I think deregulation will unleash a lot of productivity. And I also think that the tax rate has to stay low as it is. If taxes don't get cut, the economy is going to slow and the markets will get hurt. It's reflected in the bond market right now. 10-year Treasury yields are at 4.5%. If we were going to have a recession, 10-year Treasury yields would be 2%. And if we were going to have an inflationary environment, tip break-evens wouldn't be at 2.3, they'd be at 4.3. Furthermore, investment-grade spreads wouldn't be under 100 basis points, they'd be 300. And high-yield corporate spreads wouldn't be at 300, they'd be at 1,000. So you're not going to have a recession, and inflation is not expected to go out of the box. But for the economy to thrive, you've got to cut spending. We have to dismantle a bloated, possibly fraudulent, at least incompetent welfare state, which is spending too much money and printing too much money for everybody's good. So I think that GDP and for the year will be at 3.5% or higher. I think Q1 was probably the lowest sector. I think inflation is going to be a lot lower than most people think because, as we have seen, Amazon, Walmart, and Target all reported their earnings in the last 2 weeks. Each CFO said that none of those 3 companies have raised prices, right? None of them. And Walmart said they might, but the fact is they probably don't have to. Demand is high enough. Consumer spending in the United States in the last quarter was 5.7%. And I think that GDP would have been something like 3 or 4% if it wasn't for such a surge of in imports. If we cut the budget deficit by 200 billion, 300 billion, 500 billion, that's really going to help with the interest rate sector of the markets. If we cut the trade deficit, 200 billion looks like it's already done. That's what Joe Livornia says. Maybe it's going to be 400 or 500 by the end of the year. I think that's going to happen. That money goes directly to GDP. So again, U.S. economy is doing pretty well. There are certain sectors that are having a big problem, automobiles being one of them. There's a company called Wards that estimates automobile sales. They came at 15 million something for the year, down from 17 million something for the year last month. So the automobile sector is going to take a hit. Retail is going to take a hit. But consumer spending, broadly speaking, on services is going to continue to do well. And the main reason for that is that, the people that do have savings and who have benefited from an inflationary environment will continue to spend. You see airports are full, car rental agencies are full, hotels are full, restaurants are full, cruise ships are full. So yeah, I think consumer spending is going to keep driving the economy. And I think we have to recognize that the AI revolution is really for real. And I think that you have to be overweight technology. And I think that business spending and government spending in that sector is going to drive the economy going forward. So we'll talk about that when we talk about the portfolio. But, maybe I'm a lone wolf out here, but I really believe that the U.S. economy is doing much better than most people think and will continue to do so. Perry Capital Asset Management is a very conservative generational wealth fund. It is designed to beat the S&P 500 every year with less risk. It has done that for 30 years, especially in down years, 2000, 2008, 2020, 2022. I am allowed to sell every single stock in my portfolio. I have done that 4 times. Your active manager can't do that. The index can't do that. It's very hard to get back at 25% down trade. It takes several years, if not more. The fact is that this country continues to be my favorite place. I don't feel like I need to go anywhere else. I don't want to go to China. I don't want to go to Japan. I don't want to go to Europe. Reason being, their fiscal and monetary situations are far worse in this country, and the emerging markets are far worse than that. So return on investment in this country has been very, very good for a generation. It will continue to be so. The way I beat the S&P 500 in up years is very simply overweight several sectors and underweight several others. As most of my clients know, I am very heavily overweight the technology sector. I believe very strongly in the AI revolution. The amount of money that's being spent and being generated now in terms of revenues and profits from the big mega scalers is unprecedented. That will continue. The reason being is that the U.S. economy and the people behind it are innovative, they are technologically advanced, and they are risk takers, and they are not afraid to fail. And that's what it takes to build out a new technology. It is on par with the Industrial Revolution and several revolutions before that. And in fact, it's probably going to be 10 times, 20 times higher than that. So that's where investors need to be. That's where I am. I publish parts of my portfolio every month. I am overweight technology. I believe that to be the case. I'm overweight Swiss francs on a tactical basis, and I'm overweight gold. I'm also overweight on a tactical basis defense stocks, because I believe the world's slightly dangerous now because our current president is a little bit more confrontational with our major adversaries, that being, of course, China, Russia, and Iran. So overweight defense, overweight technology, and have some Swiss francs and some gold. That's where we are. That's where we're going to stay. If you'd like to know more about it, you know where to find me, and I would be happy to talk to you about it anytime you want. Thank you. Bye.